As of this moment, Nuburu, trading under the ticker symbol BURU, is priced at $0.09 per share, marking an intraday drop of 3.23%. Now, the immediate reaction to a single-digit penny stock showing minor fluctuation is often a shrug. Most people see the ticker, see the sub-dollar price, and lump it into the vast category of speculative, high-risk ventures with a lottery ticket-like appeal. The prevailing expectation is that its fate is tied entirely to some future technological breakthrough or a landmark contract announcement. But that's not the real story playing out right now. The urgent, under-the-radar narrative for Nuburu isn't about its fascinating blue laser technology. It's about a desperate race against time on its balance sheet, a story of financial engineering and survival that the market seems to be underestimating. The apathetic daily drift of the stock price masks a very real, high-stakes situation that could see its valuation either evaporate or multiply in a very short period, depending not on its labs, but on its negotiations with lenders. The common belief about Nuburu is straightforward. Here's a company with a genuinely interesting piece of industrial technology. They design and manufacture high-power blue lasers, which are particularly effective at processing metals like copper and aluminum. This has massive implications for industries like electric vehicle battery manufacturing, where welding copper is a critical and challenging step. So the expectation is that as the world electrifies, a company like Nuburu, which holds key patents in this area, should be perfectly positioned. Investors looking for the next big thing in industrial tech through their SoFi Invest or Robinhood accounts might see BURU and think it's a ground floor opportunity. They see the connection to the EV supply chain, a sector dominated by giants like Tesla stock, and assume a rising tide will lift all boats. They believe the core challenge is market adoption and scaling production. However, the reality is far more complex and immediate. The primary obstacle for Nuburu today isn't convincing a company to use its lasers. It's convincing its creditors to give it more runway. When you examine their recent financial filings, the picture becomes starkly different. The company has been operating with substantial net losses and negative cash flow, which is not uncommon for a company in its growth phase. The critical issue is the structure of its debt and its dwindling cash reserves. These are the details that professional traders on platforms like Interactive Brokers are scrutinizing. They aren't just looking at the tech, they are looking at covenants, maturity dates, and the very real possibility of insolvency, or more likely, massively dilutive financing. The stock's recent performance reflects this underlying tension. It has been caught in a brutal downtrend for over a year, with its 52-week high sitting multiples above its current price. The trading volume is often thin, meaning that any significant buy or sell order can cause disproportionate swings in the price. This isn't the kind of stable, long-term growth you might find in blue-chip Fidelity mutual funds. Instead, it's a highly volatile instrument where the day-to-day movement is less about sector momentum and more about survival speculation. For anyone practicing self-investing, understanding this distinction is crucial. An investment in Nuburu is not an investment in the broad market. It's a very specific bet on the company's ability to navigate a precarious financial situation. The company itself, Nuburu, commercialized the first high-power blue laser and has built a portfolio of intellectual property around this technology. Unlike infrared lasers, the blue light wavelength is absorbed much more efficiently by metals like copper and aluminum. This has significant advantages in applications like welding the foils and tabs in EV battery packs, 3D printing, and even certain aerospace and defense applications. The company came to the public markets via a SPAC merger, a popular route for many tech firms a few years ago. That initial public offering generated excitement and a much higher valuation, built on projections and the promise of widespread adoption. The reality since then has been a painful reset, as operational and financial headwinds proved much stronger than anticipated. Revenue growth has not materialized at the pace needed to offset the high cash burn rate required to fund research, development, and operations. This is the classic disconnect that plagues many post-SPAC companies. The narrative sold to early investors clashes with the harsh reality of execution. While an automated service like Schwab Intelligent Portfolios is designed to steer clear of such single-stock risk, many retail investors using a standard individual brokerage account were drawn in by the initial story. Looking at the immediate future, Nuburu's path seems to fork into very distinct possibilities. The optimistic scenario, the one bulls are clinging to, involves the company successfully securing a new round of financing on favorable terms, or even better, announcing a strategic partnership or major purchase order from a top-tier automotive or battery manufacturer. An announcement of that magnitude would serve as a powerful validation of its technology. It would signal to the market that its blue lasers are not just technically superior, but also commercially viable at scale. This would likely cause a dramatic repricing of the stock, as the focus would shift from financial risk to growth potential. In this scenario, the company would use the new capital to stabilize its operations, scale production, and fulfill new orders, finally beginning to grow into the valuation that was envisioned during its market debut. It would be a textbook turnaround story, rewarding those who tolerated the extreme risk. However, the pessimistic scenario is equally plausible and is what the current stock price seems to be reflecting. In this outcome, the company is unable to secure favorable financing. It might be forced into a highly dilutive equity offering, a toxic debt deal with harsh terms, or a reverse stock split just to maintain its listing on the exchange. Each of these actions, while potentially necessary for survival, would be detrimental to existing shareholders. A reverse split, for instance, doesn't change the value of the company, but it's often perceived as a signal of distress and can precede further declines. The greatest risk is a complete cash crunch that forces the company into bankruptcy protection or a fire sale of its assets and intellectual property. This is the reality that tempers the exciting technological narrative. The best laser technology in the world is of little value if the company runs out of capital to operate. Investors accustomed to the relative stability of large-cap tech stocks like Apple stock or Nvidia stock need to understand that the risk profile here is in a completely different universe. This brings us to a critical question about the company's next steps. Given Nuburu's critical need for funding, comment below what you think their next strategic financial move will be: a private placement, a public offering, or seeking a buyout? Your perspective on their corporate finance strategy is just as important as an opinion on their laser technology at this juncture. This is the kind of focused analysis that is necessary when looking at investing sites for opportunities beyond the mainstream. Whether you're using the Fidelity mobile app to check on your positions or executing trades on the SoFi trading platform, the underlying financial health of a microcap company like this is the most important factor. In conclusion, the story of Nuburu is a classic case of expectation versus reality. The expectation is a simple, compelling one: a company with a unique, high-value technology poised to benefit from the massive global shift towards electrification. It's a narrative that is easy to understand and get excited about. The reality, however, is a much messier and more urgent story dominated by financial statements, debt covenants, and cash flow. The company's immediate future will be determined not in a laboratory or on a factory floor, but in boardrooms and negotiations with financiers. The market is pricing in a high probability of a negative outcome, but it's a situation that remains fluid. For investors considering a position, the analysis must go beyond the technology and focus squarely on the balance sheet. Understanding this deep disconnect between the popular narrative and the underlying financial reality is the only way to properly assess the profound risks and the potential, albeit speculative, rewards of an investment in Nuburu. It requires a level of scrutiny far beyond what's needed for standard online investing in established companies. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.